Okay, thank you for coming today. We'll start. Welcome to today's webinar, Practitioners Insights Panel Discussion on ETF Liquidity and Investor Experience, hosted by the CFA Society India. I'd like to take a moment to welcome our audience from around the world joining us remotely. I'm Hansi Mehrotra. I'm the founder of Money Management India and Money Hunts. Money Management India is yet to be launched startup for the industry, and the Money Hunts is a financial education initiative. I will be the moderator of today's webinar. Before we introduce the speakers, I have a couple of housekeeping notes. So today's webinar is scheduled for 60 minutes, including Q&A. We will be leaving time for Q&A after the panel discussion. Please feel free to submit your questions throughout the panel discussion, and you can do that by clicking on the Q&A link at the bottom of your viewer and typing your questions in the box. And we value your feedback, so please complete the evaluation survey before you sign off today. Now, it's my pleasure to introduce our speakers for today's webinar. I'm still reading, so in case I sound mechanical, it's because I'm reading. Okay, so the first speaker today is Anubhav Srivastava. He's a partner at Infinity Alternatives, has 2 decades of experience in the financial services industry. Previously, he was the head of the passive business at a leading asset manager and was responsible for the widely successful Most Shares NASDAQ 100 ETF. He occasionally advises regulators on systemic risk management in addition to regular commentary on the larger investment and the ETF space. Anubhav holds an MSc in quantitative finance and is an MBA from IIM Ahmedabad. Thanks. Welcome, Anubhav. Vishal is currently the head of ETFs at Reliance Nippon Life Asset Management. He was with Goldman Sachs Asset Management Company till May 2014, where he was CIO. He has over 18 years experience with ETFs. He was part of the founding team at Benchmark Asset Management, which launched the first ETF in India in 2001, Nifty Leads. Vishal was previously part of the index division of CRISIL, where he was deputed to NSE and was instrumental in setting up India's first independent company, IISL, which is the owner of the Nifty family of indices today. Welcome.
Thanks.
Sivananth Ramachandran, CFA, is the Director of Capital Markets Policy at the CFA Institute. In his role, he's responsible for advocating policy positions on issues that impact Indian capital markets, including corporate governance, ESG, financial reporting, to name a few. He was part of the SEBI working group that reviewed the related party transactions. He's frequently quoted in the media. He has nearly 13 years experience in financial services. Prior to the CFA, he spent 5 years at Morningstar and led their global index product development team. Siva has an MBA from IIM Institute of Management, Lucknow. He holds a CFA, the Professional Risk Management, PRM designations, and the Fundamentals of Sustainability Accounting credential provided by the Sustainability Accounting Standards Board. Thank you, Anubhav, Vishal, Siva. As a reminder, you can submit a question to the Q&A link at the bottom of the screen. And now, can we get started? So, welcome again. Before we start, let me just give a little bit of context as to why we're doing this ETF panel discussion. About this time last year, I was invited by Bloomberg Quint to hold a session on ETFs. And as discussions usually go, the comment went to India is still a nascent market and the liquidity of ETFs is not so great. And this is the comment I hear over and over and over again, everywhere I go. So when the CFA Society recently issued a paper, so Siva was part, a co-author, along with Nilesh Saha, right, Siva? I was super excited. And then I saw another paper by Anubhav Srivastava. So I thought, what else to do than get the 2 papers together, get another person, experienced person to the panel, and actually debate it out, and hopefully at the end of today actually reach a conclusion. So that's the context. Now, can I switch to the slides? Sorry for just 1 second. Okay. Actually, can everyone see the slides?
No.
Okay. So we now have a problem in that I can't see the screen. So I don't know what happened there after doing so much for a practice run. So I'm going to leave the slides for a second until we actually need it. So now let's get started. Like I said, the question that we want to address today is three questions, the agenda for today. One, is there in fact a liquidity issue in Indian ETFs? Second question, what are the causes of that and what can we do about it? And third is, does it matter for retail investors? And if we have time, we will then go on to building portfolios with ETFs and what new technology and services are available to help. So now, let me sort of start with Vishal. Vishal, you mentioned that, not mentioned, I introduced you. So you were part of the founding team at Benchmark, which actually launched the first ETF back in the early 2000s. Can you quickly sort of give us a background as to what prompted Benchmark to launch ETFs and then sell to Goldman Sachs, and then they sold to Nippon, obviously. So they started the industry and then sort of didn't continue with that. Any experiences that you can share from that time and what you've seen as the evolution since then?
Well, I think at that point of time, I think one of the drivers which, because of which, we started Benchmark was the fact that passive investments internationally were gaining ground. Though ETFs were nascent at that point of time, but we kind of wanted to be pioneers to bring the latest, products into the Indian market. And that's what we actually did. So though ETFs started off possibly, in the middle of the 90s, by the year 2001, India had the first ETF, so we were among the first countries to, introduce that kind of a product, in the Indian market. Though it was very nascent, I mean, first couple of years, we did struggle in that sense, where we were not able to get enough of traction into our products. But I would say that, maybe from the fourth year onwards, we started getting a decent amount of traction with, especially one of our products, Bank Bs, which, gained nearly $2 billion of AUM, by about, say, 2007 or so. So that kind of triggered a whole flurry of, other ETFs which came into the market, and also, which led to liquidity being, a lot of interest coming in. Unfortunately, 2008, the financial crisis, came, and well, fortunately for ETFs, what happened was that triggered a lot of volumes and a lot of new people coming and trying, ETFs. Obviously, one of the reasons being that in uncertain times, investors don't know where to invest money, and therefore the first port of call is usually to, pick up an index. So we saw, decent amount of flows coming into our ETFs by about 2008, 2009. At that point of time, obviously, all throughout our journey, we were looking for maybe some kind of large investors who could help us push the ETF, to the next level in the Indian market. And that's one of the reasons why we kind of tied up with a large player, like Goldman Sachs. And I guess that was the trigger at that point of time to sell the business to Goldman, basically to take it, to the next level.
But then they ended up selling out as well. So it was the kind of thinking that India is still not ready for ETFs. I mean, what is your thinking now? Is India ready for ETFs? I mean, why are they still called nascent?
The reason, I guess, one of the reasons why Goldman kind of wanted to get out of sell the Indian business was that I think at some point of time they realized that the Indian business is still quite retail in that sense. Whereas if you look at Goldman is a very large institutional player internationally. And I think, at some point of time, they realized that, look, there's not much of value that they can add, in this market. And therefore, they kind of looked at selling the entire asset management business in that sense. So even the active and passive part both was sold to Reliance, which is now Nippon India. So that's one of the reasons, I guess, why Goldman got out. Nascent, I mean, obviously, see, India is still at a very nascent stage in general. And when you look at financial literacy itself, I mean, if you look at, the numbers that I hear is that financial literacy rates are just 5 or 6% in India, in a 130 crore population. So it's still very nascent. And if you look at that, I think what is being sold in the Indian market today, primarily, which has led to popularity of mutual fund products, is SIPs. Right. It's a very simple, product where you can just buy every month and average out your costing. So we're still at a very nascent stage, of development of the financial markets, especially the mutual fund market. And there, when you look at ETFs, which are slightly more evolved products, even in the global context, I would say that India is still fairly new in this at this point of time.
So one of the reasons, one of the things that supports a lot of categories, whether it's ETFs or alternative assets, is pension funds, institutional investors around the world. That's what the usual sort of reason given. But given that in India, 90% of the workforce actually is self-employed, they can't actually go to an EPFO and put their money in. The launch of the NPS for ordinary citizens back in 2009 was meant to give the retirement platform for retail investors to invest in ETFs, but that didn't happen. It started with passive and then went to active. So any sort of a comment there as to what happened and whether you think that money should be coming into ETFs as well? Although we're not going to active passive debate though.
Yeah, so I'm not very sure about the NPS story, but whether retirement funds should get into passive, definitely that they should, because I think one of the big triggers, for passive products is the fact that they're extremely low cost, right? And that is what, and that is what, if you see what's happening globally, a large part of the money in ETFs is now by all these retirement funds, and retirement funds are the people who have money which is 30 years 40 years money, and for them the strategy is very simple. I mean, you're invested in the best companies at that point of time, and at a very low cost. I mean, imagine if you could invest in the 50 best companies in your country at that point of time, like for example something like a Nifty Bs at 0.05% expense ratio. I mean, it's like dirt cheap. I mean, there's hardly anything that you're paying to invest that money, and then therefore ETFs become a very natural product for retirement funds. And in a sense it's happened. I think the government in India has also realized that, and therefore the largest investor today is the EPFO, with the Nifty ETF being the largest scheme in India today. So I think it's already happened in the Indian context as well, and it's the right thing to have happened.
True, but like I said, that only represents 9 to 10% of the working force, whereas the other 90% should be, they are saving through mutual funds, and ETFs through NPS should have been the ideal thing. Anyway, let's move on to the issue at hand, which is liquidity. And just very basics, this is a normal chart of ETFs. There's obviously ETFs being bought and sold on the exchange itself, but there are two other players that a retail investor doesn't usually see, and they're the market makers and obviously the authorized participants. That's obviously how it works globally. And this is a chart of the Indian sort of, basically the same chart, but just sort of separating out what happens behind the scene, which is the left-hand part of the screen, which is the authorized participants exchanging, doing redemptions and subscriptions in cash or kind with AMC, and what the retail investor sees is obviously on the right-hand side. Now, let me jump directly to actually Shiva. What prompted you to write the paper? Given that it is sort of addressing the liquidity problem, the question that I want to ask is, what are we calling the lack of liquidity? So when someone makes a comment, what is it? Is it the low average daily turnover? Is it the high bid-ask spread? Is it the high impact cost? Is it the high tracking error? What do you think is the definition of liquidity or lack thereof?
So I think the background was, different market participants made representations to SEBI, 18 months back. I'm talking 12, 18 months back, right? So, the CFA Society India, so it was also doing some research on how to develop the ETF market further, right? So we were looking at issues of market making, authorized participants, and international experience, and what are the best practices, how should we change it, and so on. So I think that's where it started with, right? And then we realized that we have done all these research, and we wanted to kind of make sure that it's all captured in the form of a report, right? So whatever work that we have done, whether it's it's for the industry or it's for regulator or it's for just for our members, right? So we just wanted to make sure that it's captured, whatever. So Nilesh and I were part of where I was volunteer at that time, and both of us were working, with the CFA Society to make sure that we are doing the research, right? So that's where it started with. In terms of your question, right? So I think there are a lot of dimensions when it comes to liquidity, right? And typically these are the top few. I would say the most pertinent measure in the Indian context is the last one, the tracking error. So I think a few months back, so March, so there was an issue where Nifty index went down by, I don't know, some X%, whereas the Nifty ETF went up by 1.5% or something, right? There was a day where there was a huge market volatility, and it was widely quoted, right? So I think when people look at this thing, the biggest risk that they see is that is the ETF tracking the underlying index correctly, right? And and that is our definition of tracking error, right? So for for active funds, it's tracking error with respect to benchmark. For ETF, it's with respect to the index itself, right? So I think there is a that we looked at that particular issue, and we realized that although the standard deviation, the figures that the conventional measure, which is standard deviation of daily returns or monthly returns, depending on how you calculate it. So the standard deviation is one way to look at it. We also wanted to look at outliers, right? So which is what I think most investors seem to worry about, right? So that's what gets quoted in the media. So we also looked at some outliers, like in terms of 25th percentile, 50th, 75th percentile. What is the variability in 12-month returns, for example, right? So I think by our own calculations, those variability could be quite high. So we estimated 50 basis points at 75th percentile and something like minus 50 basis point at 25th percentile, right? So essentially, if you buy and hold an ETF, right? So potentially quarter of the time, you can outperform the so-called Nifty index by 50 basis points or underperform the Nifty index by 50 basis points. That's a lot of variability. So I think that's I would imagine that's the most pertinent measure of liquidity. Other things are true. I think we also looked at turnovers and bid-ask spreads and those measures. But I think this is where I think this what seems to make news, so to speak.
Okay. So I've actually put up the last available sort of table of just the Nifty 50 and the next 50. And you can see in the columns, there's the returns, there's the annualized tracking error, 1 year and 3 year. There's the daily average volumes, and there's also the impact cost. So let me now turn to you, Anubhav. These numbers to me, sort of ranging from 0.19 to highest seems to be about 0.6 here, don't seem to be that bad. I mean, on the 3-year basis, there's like a 4% tracking error here. In your opinion, are these numbers sort of within what you expect? How do you define liquidity?
Okay, so the purpose of this tracking error, and it serves that purpose rather well, is to distinguish between which are the well-run ETFs and which are not. I mean, this quantum Nifty ETF, I think, which is the one with that 4.17% tracking error, I think is a problem, right? It is, again, a relative measure, right? Tracking error is essentially how closely, and again, this is a standard definition. It's also there on the CFA's the handbook on ETFs. It is essentially how closely does the index track the benchmark, right? And this is done on a daily NAV basis. It has little to do with the price, right? That is the first point. And this essentially measures how good a fund manager in this context, if you can call them that, are as compared to other fund managers managing similar ETFs. So for example, if you were to compare the Bharat Bond ETF with Nifty Bs, I mean, that would not be a fair comparison. But within Nifty ETF category, which you have a bunch of these out here, it'd be pretty easy to see which are the good ETFs and which are something that you might want to avoid at some point in time. So that's the first point. Second point is Siva mentioned the price dislocation that happened, right? I don't think it's a price dislocation. This is your standard premium or discount that prevails between the market price, the traded price of the ETF, as compared to the INAV or the ENAV. That is published by the AMC, which is again something that you showed in an earlier slide, right? And this is the reason why authorized participants exist. Now, when you have a premium, when in that example, when the index went down and there was a huge demand for the ETF, or there was very low liquidity or some such thing because of which the price went up, an authorized participant at this point in time will create those units with the asset manager, and then go and sell them in the market. And the difference between what the index is trading at and what the ETF is trading at is essentially the spread that they make, which will close it out. So ideally, it will go back to the longer term tracking error kind of thing that you would have, right? So that is the thing. And that again is the reason for authorized participant to exist and provide liquidity, which is kind of relevant to our current topic of discussion. Right, so tracking error and premiums and discounts kind of are different sides of the coin. They do tackle measures for retail investors or institutional investors or HNI investors, but again they deal with different things. The other bit is this bit about bid-ask spread and those kind of things. Now let me be very clear that bid-ask spreads are relevant for trading purposes. And over a wide bid-ask spread over a longer period of time will impact returns. However, if you are typically a buy and hold longer term investor, or you're running one of these asset allocation strategies, or you're doing one side of the trade, I mean, it doesn't really matter. And that 0.5% dislocation and the differential in returns and all, I mean, if you were to look at the market today, right, when your market movement is 3% and 2% and 1% on a daily basis, the entire expense ratio, the premium discount, whichever side of the trade you're on, will just disappear in that daily liquidity. And for the rest of the year, your cost is gone.
Okay, so am I hearing you say that the tracking error is a function of the fund manager capability? The bid-ask spread, you're saying, is not an issue. What about the average daily turnover or impact cost? At the moment, we're still defining when people say there's a lack of liquidity, what is it that they have a problem with?
So if you go to, in that paper that you mentioned earlier that I had written, which I think the first version of it, this was published 10 years ago. So we're still debating it.
This one?
Yeah, this one. So the daily turnover is a function of interest in a particular ETF on the exchange, right? That interest is not just a function of liquidity, availability, or any such thing. It is also a function of how well that particular instrument has been marketed, right? So if nobody knew about Infosys or HDFC Bank or any of these stocks, I mean, there'd be no trades, right? Secondly, turnover is a function of, ETFs are by and large building blocks, right? So there needs to be a use of those ETFs. I mean, generally buying, Nifty Bs and holding it on for 10 years is probably not a great strategy. Now, at the retail level, when you have, again, as you mentioned, the investors may not necessarily be very sophisticated or all. They need a shrink-wrapped solution, so to speak. Whereas at the other end of that spectrum, the requirements of the institutional investor is that certain market mechanics need to be in place. Namely, that they don't want to go around to the AMC and sign papers and transfer money and all of that. They simply want to execute an order on the exchange. For that, market maker needs to be large enough to fulfill that order. And if the market maker is large enough and there's still a non-availability of those ETF units, then the AP needs to be big enough to fill that, whatever that order is. And I'll give you an example. People say the mid-cap space is pretty small. Now, I remember back in my ETF days, we've fulfilled a 135 crore order in a single day. ETF,
right,
on the exchange for an institutional client.
Okay, coming to you, Vishal. I mean, where do you stand on this? I mean, as now, just looking at the chart, the funds that you manage have the lowest tracking error, lowest impact cost by the sound of it, look of it, and one of the largest AUMs. So, in your view, what do you define as liquidity or lack thereof? And what are you finding as issues when you're managing the fund? Do you think it is, in fact, the scale, the size is like, is there a minimum sort of scale that you have to reach to be able to manage well? Do you think, I'm sure you won't comment on your competitors, but do you think that could be the reason why we're looking at other issues?
Let me first start off by, answering to a couple of comments that Shiva made. One is that, he said that there's a gap of about 0.5% in the bid offer. Not in the bid offer in terms of it going into a premium discount or so. Now that premium discount depends. I mean, it depends on what kind of ETF there is. For the ETFs where there are futures available. So for example, where there is a, thriving futures market there, for example, a Nifty future or bank futures, I would tend to think it's half of that. Typically market makers, are very easily able to create units at about 0.25% above NAV and are able to, buy back units at about 0.25% below NAV during normal market circumstances. And why is it 0.25%? It's 0.25% simply because of the fact that, 0.1% on each side. That means out of the 0.25%, 0.1% is the STT that you need to pay for buying or selling the security. Right. So that leaves you with another 0.15% to go. Now, out of the 0.15%, approximately 0.1% is a funding cost that that market makers need to pay, because in fact they're borrowing money and then trying to do this trade, right? So about 0.1% is the funding charge for 2 days for which they need to fund the trade, and another 5 bips is brokerage. So that's how it kind of gets split. So I think that a 0.25% spread is quite fair in that sense, and that happens in a normal occasion. Now, what happened in March obviously was unprecedented, right? I don't think that you can compare what happened with March to what happens under normal circumstances. In March there was a lockdown. Okay, there were people who were kind of working from home. Nobody knew how money is going to transfer. People didn't have authorized signatories. Exchanges were struggling giving money back to people even on T+2. People in the market were scared, and I'm saying I mean, you can look at something like a VIX index, which normally trades at about 13, 14, trades at 80. All right, you can imagine the kind of fear that is there in the markets. And what was that fear? That fear was nobody knows what's going to happen to the market tomorrow. Nobody knows that if you do a trade today, whether the market's going to be open tomorrow or not. Nobody knew at that point of time what's going to happen to the economy. When is the lockdown going to going to open up? So those are the kind of things that were happening at that point of time, which led to this kind of a breakdown. And it wasn't only in the ETF market, that led to the breakdown. I mean, my debt dealers in our office were telling me that on one of the days for the first 45 minutes, GSEX didn't trade. Right. So you can imagine the kind of stress that there was in the entire financial system all the way from the middle of March to, I would say, the middle of April, and post which then things started kind of easing out. So every product has got its pros and cons, and every product requires its ecosystem. Now, if the ecosystem breaks down, the product will also break down. Right. And that's what actually happened. So you cannot kind of hold out, ETFs did badly or something like that. Is that the entire ecosystem around it kind of fell apart. Now think about the flip side. Okay, let's look at it from what are the other two products that are available for you in terms of the mutual fund industry. You have open-ended schemes and you have closed-ended schemes, right? What would have happened in an open-ended scheme? Today I come in and I put in an application. Right. And I put in an application maybe for 1 lakh rupees to buy a Nifty index fund. What happens tomorrow if the market doesn't open? Or what happens if tomorrow the market opens 10% up? You're going to have that issue there as well, right? What happens when there are underlying securities where a number of securities are trading at either the upper circuit or lower circuit? I'm not able to buy those securities. So that's a function of what's happening, in the underlying market. So I don't think that, you can pick up an ETF and say that, liquidity didn't happen or market makers are not able to provide liquidity. It's the ecosystem around it which fell apart at that point of time. And I think, it's come back now. I think things are far better than what they were earlier. That's the first aspect of it. Sorry, what was the other?
I was just asking you whether, given that both Siva and Anubhav commented on their definition of liquidity, what do you find as a fund manager? How do you define liquidity, and what do you see as issues when running an ETF?
So there are two factors in liquidity. One is when a fund manager, all right, is going and buying the underlying 50 securities, or is going and buying the underlying basket for that particular ETF. Now, if there isn't enough liquidity in the underlying basket, right, then when you are hitting a basket, because typically a fund manager in an ETF is hitting baskets at market. He's not defining the price. He's basically a price taker. He's not a price giver. Right. So whenever we hit baskets of say 50 securities, you're hitting it at market, whatever is the price prevalent at that point of time. Now, if you're hitting a 1 crore basket, the impact is X. If you're hitting a 50 crore basket, the impact is Y, right? Now, obviously, if you're hitting a basket or the underlying index where liquidity is not high enough, right, then your cost of trading finally turns out to be much higher than what is desirable. And obviously that gets passed on to the bid offer spread in the ETF as well. Right. So if the impact cost of executing the underlying basket in the fund is high, that automatically gets reflected in higher bid and ask spreads. Okay. And secondly, if your ETF is illiquid on the market itself, right, that adds to a further amount of impact, to the client. So to me, the underlying basket which you're trading should be liquid. And secondly, your ETF, when you're going and buying a decent amount of quantity, should be liquid and should be, and it should not hurt the investor while getting in and getting out. So I would say there are two aspects of the liquidity. Yeah.
So the second aspect you're saying is the impact cost or the bid-ask spread?
So both. So if you go back to your chart, if you go back to the primary market and secondary market, the previous slide.
Huh.
Right. Now you look at it this way. Now, when you look at the left side of the chart, it says primary market.
Yep.
Right. What is a primary market? The primary market is that any large institution or any investor in that sense, needn't be an institution, can directly create and redeem with the fund house. That's how an ETF works, right? So let me take a simple example for something like a Nifty Bs, right? If you wanted to create 50,000 Nifty Bs, now if the NAV is 100, you're saying if you wanted to create about 50 lakhs worth of Nifty Bs, you needn't go into the market to buy the 50 lakhs worth of Nifty Bs. You can directly approach the fund house. Okay, and create 50 lakhs worth of Nifty Bs for you at that point of time. Now here, when you are creating 50 lakhs worth of Nifty Bs at this point of time, you're hitting the underlying 50 securities, right? And when you're hitting the underlying 50 securities, if the underlying 50 securities are not liquid, then you get hit on the impact at that point of time, right? Now, assuming that this is a market maker, right? And at this point of time, let's take a simple example that the NAV is 100. Right. Now, if the underlying securities are not liquid, his impact of executing that basket might turn out to be 100.50. Right. Now, when he onward tries to sell these units in the market, he will sell it over and above the 100.50 plus his charges. Right. The same basket, if I execute it and is very liquid and I'm able to get all the 50 securities at 100.10, then in effect, what happens is he's able to sell the units in the market, he's able to offload the units in the market at a much cheaper rate. Because when he's buying the underlying securities, he's able to execute that at a low impact cost. Right? Similarly, so that's one aspect of the liquidity. That means when a market maker is coming and creating units with a fund house, what is the impact of him executing the underlying securities, right? For him to create those 50,000 units. And secondly, what is the impact of him selling these 50 securities in the market? So there are two aspects to the liquidity. Now, if you have an illiquid counter, okay, on NSE, where you want to offload these 50,000 units because those are retail lots, right? Then the impact is huge. He gets hit on the impact on both sides. And in effect, if it's illiquid, even the investor gets hit on the impact in that sense. So you need liquidity on both sides of the table. That means on the right-hand side as well as the left-hand side.
And just on the peculiarity of the Indian market, globally, authorized participants only are allowed to do the primary sort of transaction.
True.
But in India, you said anyone can do it.
Anyone can do it. And I'll give you a bit, bit of history behind that as well. I mean, when we started off in 2001, I mean, you didn't have market makers, right? In the Indian market at that point of time. Secondly, SEBI does not have a separate classification for a market maker in India, right? A market maker for me is an investor. Whereas if you look at what happens internationally is the word, as you mentioned, authorized participant. Now, if there are 5 authorized participants for say an ETF like the Spider, in the US, it's only those 5, authorized participants who can directly approach the AMC for creating and redeeming. That's how the market is over there, right? Because they have a concept where only an authorized participant can come and create and, redeem units. That's not the case in India. In India, what happens is as long as you're an investor and you can create the lot size that you can, any investor can come create and redeem the units. And if you look at what happened, say in 2001, when we started off, there weren't any market makers. So who were the investors who were coming to us directly? The guys who were coming to us directly were institutions, right? And no institution is going to create a basket to you and give it to you so that you can give them units, right? At the end of the day, the institution wants units. A lot of institutions in the Indian market also, for example, I can give you an example where, let's take an example like ICICI Bank. ICICI Bank Treasury, if it wants to create something like a Nifty Bees, where the underlying security is also where the underlying index also has an ICICI Bank, right? An ICICI Bank Treasury cannot go and buy it, right? Because he cannot go and buy his own share. And if he cannot go and buy his own share, he cannot create the basket and come and give it to me, right? And therefore, at that point of time, we went to SEBI and we said that, look, we want to do this, where we want to come up with a cash subscription route where somebody can give us cash. We can buy the underlying securities in our name and transfer units into his account. Now that mode has kind of, picked up a lot in India. And if you see that a lot of volume happens, directly with the fund house. And therefore, in that sense, volume is kind of restricted on the counters because a lot of these large institutions come directly to the fund house and create. Yes, optimally, we should be following the international model where, authorized participants should be only allowed to create and redeem. And that's the only way we'll be able to kind of push a lot of liquidity onto the markets and thereby making it more popular. And as I'm part of the AMFI ETF committee, I mean, we are in conversation and we have come up with a consultation paper, which, we are speaking to the regulators. And this is one of the suggestions that we've given. So let's see how it goes ahead. Yeah.
So on the same issue. So internationally, it's not as if like every ETF gets like a lot of liquidity either, right? So US minimum volatility is one of the most one of the largest by assets. It hardly has any liquidity in the counter, right? So because most of them, it's institutions which are buying those for their portfolios and so on. The way it happens is if you don't have on-screen liquidity, you call up the ETF desk of the asset manager, and they will arrange the basket to be available on the exchange on request, right? So the trade will still happen on the exchange, but obviously you need to, if you don't like the bid-ask spread, or if you don't like the order book which you're seeing at the moment, you have the option of calling up, right? So there are it is still it's a bit circuitous than asking the asset manager to give you the basket directly. But the fact is that because it goes through exchanges, the order size and this thing are visible, right? So I think if you believe that liquidity attracts liquidity, then that's the much better way of doing it, rather than just giving the basket directly.
Sure. So we do that here as well, Shiva, where investors approach us and say that they want liquidity on the counter, and we do that here as well. The only difference in India is that investors somehow are very price sensitive here. So if he comes directly to the AMC, right, he would possibly be, the cost of him directly creating units with the AMC is 0.15%, as I mentioned to you. For example, you'll pay 10 bips of STD and another 5 bips of brokerage. But if you pick up the same units to the market makers funding cost comes in the way, right? And therefore you have to end up buying, not at 0.15%, but maybe at 0.25%, plus the brokerage that you pay to the broker for buying those units. So therefore, a lot of institutions don't want to pay that 15-20 bips as extra, by crossing that, on the counter.
Vishal, let me just add a little bit out here. One of the other problems seems to be that this concept of INAVs, let alone ENAVs, is not taken very seriously by the AMCs. I give you an example. There was a particular AMC which runs a pretty large book on the bank, bank Nifty, bank V's equivalent, and we had a trade, and I was happily told that I'm sorry, but the INM is not working for the last 3 days. Right. So I mean, under that situation, it's hardly surprising that nobody wants to trade that, because there is no way to figure out what is it that you're trading, what is the spread that you're getting, and what is the premium and discount you're going to absorb in all of this, right, from the AP.
Okay, so just cutting back in. So we are still discussing a whole bunch of different issues defined as liquidity. Siva, in your paper, you made a bunch of recommendations based on these 2-3 things, right? You first, which is the direct redemption by large investors. Then you also had a point about the number of market makers and APs. And then here you also raise the issue of the diversification sort of lack thereof. So there are the 2-3 things that you mentioned as the possible causes of the lack of liquidity. And your recommendation was in terms of going and adding. So can you just talk through your recommendations? What have you put to SEBI, and do the other 2 gentlemen agree?
Right, right. So of course, diversification is a different issue. So of course, you can be completely liquid and undiversified, right? So that's the different issue. So, but in terms of our recommendations, it is not merely addressed towards regulators. A lot of things, like it has to come through, from ETF sponsors. It has to come from exchanges, and some of it has to come from regulators, and maybe even the government, right? So I think, like, the first thing, liquidity enhancement schemes, right? So certain things, you need to, how do I say, pump prime the market bit more, right? So I know that liquidity enhancement scheme, or what they call market maker incentive schemes, it used to be in place a few years back, but they kind of took it off because they didn't find much interest and so on. But the market is much larger today than it was like 5 years ago when they first instituted that market making incentive scheme. So just for context, Hong Kong Stock Exchange, so they rolled out an ETF market making scheme today, right? So what they said was they are placing market making obligations on, market makers and other participants to reduce the tick size on certain ETFs by as much as 80%, right? So you're talking about like huge obligations which are placed, like how much, and continuous market making obligations on certain classes of ETFs throughout the day, right? So you have to support this level of volumes throughout the day for these kinds of ETFs, right? So these are potentially broad market ETFs and so on. So I think there has to be some push, either in terms of obligations or in terms of incentives, or maybe in India's case, incentives probably work better, to kind of make sure that there is liquidity which is seen, right? So that's one. And I obviously, I think I agree that the biggest source of liquidity which is off exchange today, which is direct redemption, it has to come on exchange, and that will certainly help, right? So at least what is available should be on exchange, right? So it should not be that even if you can't create new liquidity there. And I think other things, like certain things would help. So you mentioned that, Vishal mentioned that certain ETFs don't have futures and options for hedging. So Nifty has futures. Next 50 doesn't, right? So I remember Nifty Junior, which was its previous avatar, used to have some futures. I don't know what happened to Next 50. So there is no futures on Next 50. So there are little issues that can potentially hinder good market making, or potentially efficient market making. So those things could help. I think securities lending borrowing, it is an issue. I mean, like internationally, internationally, securities lending and borrowing is a big source of revenues for ETF sponsors, right? So I know there was a Morningstar study which was done in 2018, which they said that estimated 5 to 50% of management fee can potentially come from securities lending. So that was their estimate, right? So in India, I think when I looked at many of the SIDs, so at best they do 20% securities lending, right? That's the limit. So most of them, they do no securities lending. And I spoke to one or two. They said, potentially counterparty risk we don't want to take and those different things, right? But like securities lending market itself is inactive. So anything that will help like develop that market can potentially open up avenues. But on the flip side, in India, any securities lending revenue has to go to investor. It can't go to the fund house, which means there is no incentive for fund house to actually do securities lending, even if it's active and so on. So there is like some issues there also. We just need to figure out how to properly incentivize different players to kind of improve their bottom line and so on. And lastly, stamp duty on ETF is another thing. So like the same thing about Hong Kong Stock Exchange, Hong Kong government said that they will waive off stamp duty for market makers, right, from August of this year. So I think, the problem with stamp duty on, on ETFs is that ETF price itself incorporates stamp duty of trading in the stock. So if you put another layer of stamp duty on like trading in ETF, that's 2 layers of stamp duty. So like, and a lot of jurisdictions, they have stamp duty and others don't. So for example, UK doesn't have stamp duty, and other Hong Kong said they won't do it from August and so on. So we felt that just as a position of fairness, that's one more thing that we recommended.
Right. Anubhav and Vishal, Anubhav, you said INAV there being one issue already. Do you agree with these recommendations? Would they, do you think, help in the liquidity situation, assuming?
All right. So first, I've noted about 5 odd points out here. The first one is diversification issues. The second one is incentives for trading and those kind of things. The third one is futures, which is the hedging aspect. The fourth is SLB, and the fifth is stamp duty, right? So I'm just going to quickly, I know we're short on time, so I'm going to quickly take this. First of all, diversification issues exist everywhere in the world, right? We cannot have a scenario where we don't have diversification issues. And I think that SEBI is very right in implementing some diversification issues. Having had conversations with the SEBI members in the past, they have taken some of the best practices from different parts of the world, implemented the Indian angle to the whole thing, and done it. US, like let's take the example of NASDAQ 100, which you mentioned earlier. It follows the RIC, norms, which is the 25-5-50 rule. I'm not going to get into the details of what that is. In Europe, there is your UCITS norms, and both of these have been incorporated in the Asian markets as well, including India, to an extent to get those. So I don't think we're going to be able to get around the diversification issue. And the reason for this is SEBI has had bizarre ETF requests in the past. For somebody wanted to launch a steel ETF and somebody wanted to launch a tire ETF and all that. So those things just don't work, right? I mean, you can't have retail investors being exposed to those kind of things and a whole bunch of other issues. You'll have price dislocations in the underlying market if you do one of these things. Obviously, there were other interests that wanted to do it. So that's the first part of it. There will be diversification. Yes, SEBI constantly looks at changing the diversification rules. So I think we will see some changes over a period of time, which will be adaptable to the markets. The second bit of is incentives. I don't think incentives will work in India. There have been incentives from the exchange. There have been incentives of all kinds of things from BSE and NSE and all of that, and none of those have worked. I think the problem out here is the availability of overlying products to create interest and to cater to the needs, as I mentioned earlier, to all the market segments that actually buy ETFs. HNIs, the wealth management clients, your retail clients, and the institutions. Unless AMCs themselves, or there are external parties, such as these platforms that are out there or advisors to these portfolios, they get into the act, this will be a problem, right? Having said that, currently, if I participate in the ETF market, I have no issues of liquidity or any such thing, because everything that has been mentioned out there is available at my disposal. I can just call up someone. I can call up Vishal and say, okay, fine, I need liquidity in XYZ thing, whether there's an underlying basket that has or does not have liquidity in some 3 counters, right? If there's a 150 stock basket, the 3 counters are immaterial, right? Which brings me to another point, which is materiality of whatever the impacts we're talking about. Again, as I said, if you are moving your market by 2% and 3% and 1% every day, any impact that is under that number will cease to matter in your annual holding of that particular ETF and all of that. So the larger point is, are we looking at materiality of it, or these are minor issues that will get sorted over a period of time? The next bit of it is the incentive bit of it. Now we've got that issue that was raised, I think, in one of our earlier discussions on not here, elsewhere, on that 2 BIP that is investor education fund, and I'll leave you to comment on what's happening there. But I think that money can be used to incentivize market makers to create liquidity. Worst case scenario, what happens? There's some circular trading, which is fine. The guy is getting paid for it. At least there's visible liquidity. It solves all of these problems of institutional investors coming directly onto the exchange and all that, because whatever liquidity you want, at least a couple of baskets are there. And SEBI has also ensured that if you don't have that 1 basket and 2 basket of liquidity available, there's a formula to that, then there is this availability of, for retail investors to go directly to the AMC, and at a 1% discount, they can go and redeem their ETF units with the AMC. I think eventually that will not matter, because I have never seen anybody actually taking advantage of that. As far as futures and hedging is concerned, today you have, vanilla ETFs like Nifty Bs and so on, and you have exotic ETFs like NASDAQ 100. And then in between somewhere you have the mid cap and all that. And bank Bs is more like Nifty and all that. So in a lot of cases, you do not need to have a direct futures, right? You can have a correlation hedge. And that is how a lot of these, mid cap market makers are running. They're just simply correlating it to the Nifty and hedging out there. So that market is there. I think, sure, it would help, but that 2-step process is going to take a long time. I think if we solve a bunch of these issues, that automatically gets the futures in, and in any case solves the liquidity issue. The next bit was the SLB bit. Right now, this is back in the day when Goldman was running the old benchmark book, and I remember comparing notes with somebody from Vishal's team, or maybe Vishal itself, I don't remember. And I think that their junior Bs and my mid-cap product, we were able to defray 75% of the TER, which interestingly at that point in time was 1%. And we were delivering an expense ratio of something like 20-25 basis points to the investor. Whereas the TER was 1%, which means the AMC was actually making a 75 basis point fee on that. Right. So to Siva's point earlier, so why you have SLB, the incentive is that you can actually deliver a cheaper product. The tracking error is low, which is good for the ETF. And at the same time, your revenue remains constant. And I don't think that the bit about all the monies accruing from the fund should go to the investor rule that SEBI has is going to change. So that's something that we have to live with.
Okay, so if I hear you saying, so these were all the points that Siva raised in his paper about what the reasons could be for lack of liquidity. And you are saying one by one, you've answered them, but more importantly, you're saying that they're not material issues to start with. And you have gone ahead and used the latest technology to go and build portfolios using ETFs. And you're going ahead and recommending to your clients. You are not, it's not stopping you from investing in ETFs, right?
Correct. It's not stopping me at all. And
right.
Yeah.
Okay. So is there anything that should stop anyone from investing in ETFs? Vishal, do you have any other point on this? Or, the point that I should ask you, given that you're a fund manager, what does happen to that 2 basis point? Do you as a sort of ETF pay that? And if that's going to the AMFI and the other sort of thing, are you sort of confirming what I suspected? Are passive investors paying for the education of active investors?
Well, the 2 bips is definitely being paid, across all our schemes. And you're right, 1 bip goes to AMFI and 1 bip goes to SEBI. But, we're in the process of, I think AMFI is in the process of using up that 1 bips for ETF. So you would find, hopefully in the next couple of months, a lot of education happening, from that 1 bip towards ETFs. It's not been happening till now, but it will happen going ahead.
What has changed? Why are they doing it right now? Do you think, have we arrived at that ETF moment?
I think so. Yeah, I think, see, there are more and more asset management companies now looking at ETFs, in a big way. And I think that's what's, leading that change.
Right. Okay. Like I said, I did find, obviously there are a couple of technology places, firms that I found in the market that are already sort of enabling model portfolios and stuff to start doing. I'm conscious of time, and therefore let's jump to questions, and hopefully we can take a few of them. None of them have been upvoted, so there's quite a few. Does it make sense to choose an index open-ended fund instead of ETFs, considering the liquidity issue? Well, that was the whole point of doing this whole exercise. Does anyone want to answer that? Vishal?
Yeah, I'll answer that. I think structurally, one has to understand that ETFs is a very forward-looking structure. I keep telling people, in the world we've had petrol cars and diesel cars. Yeah, it's electric cars that we're talking about now. They're the future at the end of the day. Till now, in the mutual fund industry, has been very similar. You've had the close-ended structure, you've had the open-ended structure, and now you have ETFs, which kind of solve a lot of issues that are there in the close-ended and open-ended structure. So in terms of a structure, it's a far more efficient structure to work with. Even if you look at tracking error of an ETF versus an index fund, the tracking error is much lower in an ETF. That's the first point. The second point is, I think it's more important for investors to look at the passive philosophy as a way of entering the market. Here I'm not again getting into an active passive debate. I think every investor can decide how much of his portfolio he wants to index and how much he wants to do through direct stocks or active stock picking. And I think so I would say that the main thing is that people should look at a passive product simply because of the fact that it's extremely cost efficient. And there it doesn't matter whether you choose an index fund or an ETF. Choose an index fund if you don't have access to the markets, or you don't have a broking account, or you don't want to get into that rigmarole of opening a demat account and a trading account and stuff like that. Then go in for an open-ended index fund. If you're already a regular trader in the market and you have access to the stock markets, then I would say buy an ETF.
Right. I would say that, we're trying to develop the market here, right? As much as mutual in open-ended funds make it easy, there are plenty of market exchanges and other tools that are making it even easier to open a demat account and trade in ETFs. So I think just because you've not done it doesn't mean that you shouldn't do it. So I don't know. I think we should encourage more people to actually come to the market. Specific question on the APs. Is there a definition of AP in other jurisdictions? And similarly, in the US, you have ETFs that have tie-ups with brokers who offer commission-free ETFs. Are you working towards a similar model in India?
So two things. In India, we are not allowed to play commissions, right? Because you have two types of schemes in the Indian market as per SEBI regulations. You have a direct scheme and you have a regular scheme, right? A regular scheme is where you pay distribution commission. Since an ETF is only one scheme which is listed, right? It's automatically a direct scheme, and in a direct scheme we cannot pay any commission. And that's one of the reasons why ETFs have taken time to kind of pick up, is because there is no distributor selling it, because he's not making any money out of it. So yeah. I always keep telling that ETFs are bought, they're not sold at the end of the day.
This answer was for commission free. I think they're talking about brokerage free ETFs, not commissions in the distribution sense of mutual funds.
Well, I think that depends more on the platform. If you go to platforms like Zerodha and all, there you can buy ETFs which are commission free, right?
Right.
Where you're not paying too much of money. So I think that's more broker-led. I don't think the AMC can play any part in that. And what was the second question, Hansi?
So there were two questions. One was the definition of AP.
Yeah, AP. So there is, so internationally, yes, authorized participants are defined, and authorized participants have an obligation. They even have to sign agreements with the AMC as well as the stock exchange. Right. And there are certain parameters that are defined in those agreements, that they have to give a quote, with XYZ spread at any given point of time, and that at no given point of time that they cannot give the spread, and they have agreements like that. But that's not the case in India at this point of time, because there is no separate definition of who a market maker or an authorized participant is in India.
Right. Some people have pointed out the mistake in what you said, Vishal. So 2 basis points, one goes to AMFI and one is spent by the AMC. You mentioned, I think it's going to SEBI, so somebody has corrected us.
I'm sorry.
But yeah, that was just a
that goes
slip of the tongue.
Yeah.
Okay, so other questions coming in. Is there a difference in STT impact if the investor directly goes through the fund?
Is there an STT impact if the, no,
Investor?
so STT is paid only once. STT is only paid when units are created. And again, if you're buying units on the stock market, there is no STT on the ETFs while buying ETFs on the stock market.
Right, okay.
So again, just to clarify that, so for example, if an authorized participant comes to us and creates 50,000 units, he pays the STT there for buying the underlying securities, which are the 50 securities, and for creating the 50,000 units, right? But when he's selling the 50,000 units on the stock market, there is no STT levied again on the stock market, either for the authorized participant while selling or for the investor when he's buying.
Okay, so Rahul Agarwal from CFA Society is asking 2 questions. What is the outlook on tax efficient ETF wrappers, ETNs, ETPs, single and multi-factor ETFs beyond the current ones available becoming a reality in India? And wouldn't the ETF issuers tying up with brokers to allow the buy and sale of ETFs without incurring brokerage possibly give a fillip to ETF volumes?
Can I take that?
Sure.
Yeah, please.
Yeah. All right. So first is, what is your, start off by multi-factor ETFs and all of those things. Basically, smart beta world over is dead, more or less, right? And the reason for it is essentially it was a translation of actively managed philosophies into more of a, algorithmic sort of outlook to the whole thing. So what has happened is the markets have proven to be far more efficient than that. So what you would really need is a bunch of these things with an overlying algorithm, which will switch between all of these multi-factor ETFs. Morningstar had some interesting strategies, like, you have market factor tilt models and so on. So we had one back in the day, and which then led to your NV20 type structures. I don't think they have done very much, right? ETPs exist in the market right now. All your gold ETFs are essentially ETPs because they have exactly one underlying, right? ETNs in India right now, I don't think are permitted because they will run up against SEBI's diversification norms, right? And ETN is essentially wrapping a single security inside an ETF structure and putting it out there. ETF wrappers could exist, but again, you would still need to cater to SEBI's requirement of replicating the entire index. Now, let's say you're looking at issuing the BlackRock emerging market ETF in India as a wrapper of the EEM, which is traded in the US. You would have a problem because that particular ETF essentially goes in for correlation replication. So I think that would be an issue with that in terms of how you would do it. Now, the other bit of it is tying up with brokers to allow buy sale of ETF without incurring brokerage and all that. I think, again, I will come back to my earlier point. The brokerage today is not that material. If you are looking at creating a basket of 5 ETFs and you are paying 12, 15, 20 basis point brokerage, assuming you're not going to the likes of the modern discount brokers and all that, in which case it is nearly non-existent, the brokerage is not the problem. The expense ratios are not the problem. I mean, Vishal is issuing today the Nifty Bs at around 6 bips, right, Vishal?
5 bips.
5 bips, there you go, right? And on a daily volatility of some 2-3%, it just won't matter. So, so I think, I don't think that incurring brokerage, the key point still remains, you need those platforms that you mentioned. You need a significant outreach from AMCs to the institutional guys, which are the big players in the market, and everything in between. I take it to the next level where you have now got active managers who are using ETFs across the world, especially in the European and the American markets, to effectively manage the beta of their portfolio, right? So I think the users are tremendous, except the people to use them need to be aware of what they're doing. And somebody needs to take that plunge. And I think that that thing has started. I think there are at least 10 players in the market today in India that are punting, ETF-based products or portfolios out to HNI retail markets right now.
These are kind of robo-advice platforms.
Well, don't know whether the robo, because the back end is a little opaque.
Right.
But yeah, technically there'd be that.
So I remember Tavaga, I think, launched a few years ago, was one. There might be a few others. So the point though is, so I'm going to wrap up the whole discussion here right now. So the question that I want to just put very quickly to each of you still again is, Siva, what did you conclude how we define liquidity? And do you really think it's a material problem before we turn to the others?
Yeah, so ETF is issue for a few of the for a few segments, right? So, but like for retail investors, my own calculations, and we kind of describe it, is that ETFs are a very efficient wrapper, like Vishal said. So if you are looking at ETFs versus index funds, for at least the broad market ones, whether it's Nifty or a Nifty Junior and so on, so ETFs still is worth it to go for, even with those liquidity issues. I would like to see the liquidity issues getting better, but even as of today, for at least the broad market ones, ETFs make sense.
Vishal, do you have an issue if retail investors come into your fund? And what do you think they should be aware of? What can blow up? So no surprises would be the thing that I would want as a retail investor. So what do you think of all the issues that were raised today? Are there any things that could blow up that a retail investor should be aware of?
No, I think it's again extremely important that somehow we push as much of liquidity on the markets as possible, because that leads to a lot of price discovery on the counter itself, and that itself will solve a lot of retail issues that there are. But even today, if you go to see, some of our ETFs trade pretty decent volumes. I don't think retail investors have a problem investing in an ETFs even at this point of time. I think what is important is that we need to keep spreading the word of ETFs, and we need to keep ensuring that the investor base widens. I believe that I saw this even in 2008, where when the market tanks, whenever there's a crisis in the market, you find a whole flurry of new people coming in and adopting products like ETFs. And I see that even now in terms of number of investors. The number of investors we've added in the last 2 months, we've actually doubled the number of investors that we had in most of our schemes, which would have normally taken us about 4 or 5 years. So I think that I think it's evolution. I think it'll happen. I think we need to keep talking to investors, keep pushing the word out, and I think that as more and more AMCs come out in the market and start talking about ETFs, I think it'll automatically happen. I think it's already happening. We need to kind of increase the pace further. I think there's also a question in terms of the 2 bips which is set aside for investor education. Why don't AMCs use the funds for investor education? I mean, we will start using those funds as we go ahead now, to market ETFs and index funds as much as possible as we go ahead.
Anubhav, last word.
All right, so a couple of things. One is, I think those 2 bips should be used to incentivize market makers. It has, aside of the SEBI fee, a bit of it, which obviously we need to keep an eye on the AMCs. But the first thing is that market makers need to be incentivized. I don't think that there is such the idea of educating retail investors so they can run their own portfolios and buy directly is a long shot. The better way to do this would be, again, as I mentioned this in my Deccan Herald publication last Monday, was we need computers to do this for retail investors. We should bring the cost down drastically. And the idea would be to shrink wrap a product and sell it to the retail investor. And then you can do a lot of things up from there. You can have objective driven glide path funds. You can have things like retirement portfolios, and the entire pension business can be run, as you mentioned earlier, from the NPS side, can be run on the mutual fund platform, right? Notwithstanding the advantages that NPS has from a tax perspective, right? So that I think. Now I will be discussing about this I think on Thursday on CNBC. But if anybody wants to catch up on that,
right. So you are already involved in a model portfolio, actually offering this, right?
Yes. So I've developed this about 10 years ago, and I think it just does a great job. You don't need a very wide range of ETFs in the country right now, given the variety that is available even on the active side or anywhere else. You just need about 5 or 6 ETFs, and you can, create whatever portfolio you want in whatever objectives you have. You can tailor the risk. You can, look at your returns. If your returns are outlandish, you can scale them down. Liquidity should not be a problem once you go to one of these platforms that can actually work with the liquidity and make volatility work for you.
Right. Okay, we have sort of shot over by a few minutes, so I am going to try to wrap this up right now. So as far as I'm concerned, just listening to all of three of you, is there a liquidity issue? Well, there could be, but for retail investors, the original sort of point that Siva made in his paper, he's saying that it's not really material enough for retail investors, and Anubhav, you're of that view as well. And Vishal, you're saying there are no specific issues that could stop retail investors. So if we do get that 1 basis point now to investor education, and with the new technology and portfolios, there should be really no reason why anyone should discourage retail investors who have intention of buying and holding for the long term anyway, rather than trading on a daily basis. There shouldn't be anyone really discouraging them, right? If that is the conclusion, I declare that we have at least settled the debate, I think. So now this webinar should be available to anyone and everyone who raises liquidity as an issue. And we hopefully see the ETF market grow from here and become a vibrant market. On that note, thank you very much for attending today. Sorry, it went slightly over, and I hand it back to Harshad and the CFA Society.
Sure. Thanks, everyone. Thanks, Hansi.
Thank you.
Yeah.
Thank you. Has everyone filled out the poll, please? Can I ask to evaluate? I think, is that on right now, Harshad?
Yeah, it's active, and we have got most of the votings.
Great. Okay. Thank you. Thank you very much for all of your time, for the speakers, and also to all the attendees and bearing with us. Thank you very much. Look forward to hearing more suggestions on ETFs, any issues any of us are available to answer. I'm sure you can find ways to find us. Thank you.
Thanks, Hansi, and many thanks to the CFA Society team for organizing this.
Thank you. Oh, thank you.
Bye.
Thank you, Anubhav.
Thank you. All right, I guess that's it.